In a move to fight runaway inflation, the European Central Bank has raised interest rates by more than expected, by 50 basis points. That's the first such hike in over 11 years, going beyond its own guidance. The ECB is raising rates on its deposit facility by 50 basis points to 0%, and that ends a close to 9-year experiment with negative official interest rates. The refinancing rate and the marginal lending rate will also rise by 50 basis points, respectively, to 0.5 and 0.75%. Remember, the annual rate of inflation in the Eurozone rose to 8.6% in June, which may have forced the central bank's hand. Here's what ECB President Christine Lagarde had to say about the rationale behind the move.
We decided to raise the three key ECB interest rates by 50 basis points and approved the transmission protection instrument that I will refer to as TPI. The Governing Council judged that it is appropriate to take a larger first step on its policy rate normalization path than signalled at its previous meeting. This decision is based on our updated assessment of inflation risks and the reinforced support provided by the TPI for the effective transmission of monetary policy. It will support the return of inflation to our medium-term target by strengthening the anchoring of inflation expectations and by ensuring that demand conditions adjust to deliver our inflation target in the medium term. At our upcoming meetings, further normalization of interest rates will be appropriate. The front-loading today of the exit from negative interest rates allows us to make a transition to a meeting-by-meeting approach to our interest rate decisions. Our future policy rate path will continue to be data-dependent and will help us deliver on our 2% inflation target over the medium term.
All right, this is in fact a momentous occasion, and we'll help you understand the significance of that move by the European Central Bank. Meanwhile, back home, the Reserve Bank of India's Monetary Policy Committee, which was scheduled to meet from the 2nd to the 4th of August, has delayed that meeting by a day, and it will now meet from the 3rd to the 5th. The central bank has cited administrative exigencies for the cause for the postponement. Let's also get you the latest updates from the US markets. You have the Dow Jones Industrial Average that has opened with cuts of about 0.5% in the first hour of trade. It's down about 0.6% or thereabouts now. The S&P 500, it's trading with cuts of about 0.4% or so. And you also have the NASDAQ that is trading with cuts of about 0.33%. Now, the latest data point in the US is perhaps a little bit of a cause for concern because you have the US jobless claims data that has come in, and it has hit an 8-month high. It has come in at over 250,000 last week, and that's above the estimates. And all of this, of course, has to be seen in the context of slowing economic activity in the US. We'll help you unpack all of this. In fact, my guest, Manish Singh, the Chief Investment Officer at Crossbridge Capital, is probably going to be best placed to tell you how to make sense of this. Manish, thanks so much for taking the time. Quite a lot to talk about. One, you have the ECB move, more than expected, the rate hike that has been done. You have the jobless claims data. You have worries about inflation and on economic growth in the US on account of that jobless data. How are you reading the latest signs in these two major economies?
Yeah, hi Alex, good evening. Well, first thing to point out is that we've seen 50 basis point hike from the ECB, and I can see on my screen, Bloomberg screen now, Euro USD is now lower than when the rate hike was announced. I mean, this is probably the first fake rate hike that has happened from a central bank, in my opinion, just figuratively speaking of what's happening on the screen. The market just does not believe for ECBs that ECB can raise rates, especially when you are heading into a recession. The same indicator you're having in US as well, that there is a recession about to happen. So the central banks are really caught in a bind. They see high inflation, they have no other tool. They think that the window to raise rates is running out because once the recession hits, no central bank is going to raise rates. So what you're really seeing is a run or a race to see how high you can get the rates, i.e. create a headroom before you'll be forced to cut when you're faced with recession. So it's really very extraordinary times that we are seeing in the market and in central banking. And I'm not saying it is a fault of the ECB. I'm just saying that, how the things are just stacked up against the central bank. And this calls into question a lot of monetary policy that we are going to see in the future. So this rate hike, at least the market for now says, doesn't believe it because Euro USD actually is lower from the point that 50 basis point hike was announced. And this is the challenge because the problem we are facing is not from what central banks can or cannot do. The problem is coming from the supply side problems, the problems of easy fiscal policy that you have seen in the US, and the problems that you're seeing on the energy front because of the US-Ukraine war. Central banks can do nothing about it. I mean, their hands are tied. All they can do is raise rates, talk about guidance. Any rate hikes now or more rate hikes now means fewer rate hikes in the future or rate cuts in the future. And this is where the central banking is at this time. So overall speaking, I think I do not expect that the central banks can afford to be hawkish. They're being hawkish and sounding hawkish because inflation is high, but they just can't afford to be more hawkish. They cannot do more rate hikes. I think you will see the same in US as well, that it'll be challenged to see how many rate hikes it can push through before US tips in recession. And as you mentioned, the jobs data, that is making a grim reading as well. So not a very good place to be for central bankers and to carry on their policies.
Manish, I guess you could call it a momentous occasion, the reversal of that negative interest rate regime that has pervaded most of the last decade in Europe. But to your point on supply side inflation, one would assume that if crude is already cooling off just a tad bit, it's around that $100 per barrel mark, whereas a couple of months back you were talking about it being at 120. You have a lot of commodities that have cooled off quite a bit from the highs that they have been at over the last year or so. But to say that there is no demand side inflation would perhaps be erroneous, wouldn't you agree? Because certain indicators in terms of demand for auto, for example, in the US has not slowed down. You have the secondary car market that has also been booming. You have inflation that is quite high there. So would you say that this perhaps the only choice that they have to prevent stagflation-like scenario, and stagflation is bound to occur perhaps in Europe anyway?
So if you talk about the US, look what happened, and you rightly mentioned about the used car market. I mean, that data was very high. All that has collapsed. In the recent ones, what you have seen coming through, this is now coming from the rents. So in the CPI basket, the items are shifting. So the first phase you saw when the inflation was high, it was being driven by very high inflation in the used car market. That has come down rapidly. And at that time, the rents was not a problem and the energy was not a problem, and that became a problem. Now that is coming down. As you rightly say, that the commodity market is coming down rapidly. You've seen the collapse in price of corn just last week. You've seen the wheat prices and corn prices are now lower today than it was when the US-Ukraine war started. And remember, everyone talked about that we are going to have a food crisis. Well, the war is still on and the prices are collapsing. Now, the commodity market works in a very strange manner because there's storage costs, there's speculation. And as soon as you start ringing the bell that recession is coming down the line, a lot of hoarders and speculators are going to put their supply on the market and the price starts collapsing. So that's another thing to bear in mind when people talk about trading commodities, that be careful of supply hitting the market. You may not have a shortage. Shortage can be created because you can store the item and you can pay for the storage. So there is that thing going on. Central bankers, they cannot. I mean, remember, Chairman Powell was asked by the Congress that Is raising rates going to bring down food prices? Answer is no. Is raising rates going to bring down inflation? Answer is no. It can do to some extent. I think it's not entirely correct to say no, because if you raise interest rate enough to, let's say, 20%, you can crash the economy, you can crash the demand, and you can bring the inflation down by that. But that's not what central bankers are in the business for. They want to maintain price stability and they want to maintain growth. So they are in a difficult situation. The supply side problems are being addressed, but not fast enough. The commodity price coming down is going to help, and central bankers will struggle to do what they can do. Stagflation-like scenario is building up. I am not of the opinion that inflation will continue to be high. I think that inflation has peaked. You saw the inflation number in Canada that came out yesterday, the first G7 nation where you saw the inflation expectation, the outcome was lower than expectation. That's the first one that I have seen, which is indicating that we have seen peak inflation. But for numbers to come down from 9% level, headline level, down to, let alone 2, but down to 4 or 5 will also take time. And which means that we could go through maybe a few months of inflation running at headline, at least the headline number running high, and central bankers will have to think about how high they can raise the rates. Should they bring in a recession now, or the numbers will come down steadily, and they don't need to overdo the hawkish tone and hawkish intent.
Absolutely, Manish. And in fact, this is a topic for a broader philosophical or intellectual conversation about the efficacy of monetary policy. But I guess we'll have to have that on another date. Thank you so much for joining in.
My pleasure.
Always a pleasure.